have a sheet on each of your chairs on some of the benefits of tax reform. We've put together a short video that captures some of the wins in Arizona and nationally. Could we please roll the tape?
You have started a feeding frenzy of economic growth.
Walmart announced that it will raise entry-level wages.
AT&T claims it's going to pay a $1,000 bonus.
Well over 2 million workers have already gotten a pay raise, a bonus, increasing contribution to their pension plans.
More money in our pockets as workers, as American consumers.
Every single income bracket in almost every congressional district sees their tax rates go down.
We are going to bring at least $4 trillion back into this country.
This is not fake news, it's real news, and it makes a huge difference.
And I think this prosperity should continue for years and years.
And now I have the great pleasure to introduce our guest speaker this morning. As I mentioned, Congressman Schweikert is not able to join us, but his legislative director, Dimenstein, who I believe has been with the Congressman for about 6 years, and before that worked for one of my favorite United States senators, Senator Joni Ernst from Iowa, is going to give us an overview of the tax reform bill. And then I am going to moderate a discussion with some of the points of the tax reform bill. Without further ado, please welcome Kat to the stage.
Hello, good morning, everyone. I know Congressman Schweikert is incredibly disappointed that he can't be here today. He was texting us on the hour, every hour, to see whether there were any flights that were popping up that could get him here, and I know that he'll hope to catch up with everyone in the coming weeks regarding tax reform, because this is kind of his number one priority, is helping folks understand what the bill did and the positive effects on the economy. So he's incredibly excited, and he's very disappointed to miss this. I did promise him this morning that I would go through some of his slides briefly. He did remind me that all of you guys are pretty much his best friends in Arizona, and that he would hear back on any of the slides I missed. So I will make sure to hopefully do as much of a David as I can. But of course, I couldn't possibly be Congressman Schweikert. So with that, and I was warned not to use this laser on anyone. So some of the stuff that I'm sure everyone has heard about is the predictions of 18,000 new jobs and $2,000 plus of take-home income for the medium households. But what David really wanted me to portray is the optimism that he feels we can expect in economic growth in the coming years. The debt held by the public, which is one of his favorite things to talk about, and I'm sure all of you have heard him talk about the significance of, is continuing to climb and is continuing to skyrocket. And the only way that we can do this is stop spending, which the federal government isn't known for doing well, or have serious economic growth. Right now, CBO is projecting that as we continue to have our entitlement spending grow, the defense budget and the non-defense spending is going to continue to be sandwiched into smaller and smaller portions of what the federal government spends money on. But most troubling, of course, is the interest on the debt, which continues to grow. And at the end of the day, we don't want to be paying most of our bills in interest. This would be a really fiscally irresponsible way to run a household, and of course, very irresponsible to run the federal government this way. As you can see, entitlements are rising in portion of the economy and in portion of federal spending. Meanwhile, the other important programs like education, the military, and all of the important other activities that the federal government does, including border security, including enforcement within the police force from the federal grants, is all being kind of squeezed out. David always talks about and reminds folks that the inherent inequalities that we hear about in the news of the individual income taxes has to be taken with a lot of grains of salt, perhaps bags of salt, because the top 20% of income earners are paying over 80% of our taxes. It's something where we hear this is a massive tax cut for the rich, this is a massive tax cut for the rich, but at the end of the day, it's actually just a massive tax cut, and the folks that are paying the most taxes are going to see impacts. Everyone else will as well. So, GDP growth, David's favorite topic. GDP needs to continue to grow, and if we don't do something to stimulate the economy, the combination of entitlement spending and increases will inevitably bankrupt this country, and the best way to get out of it will be through growth, economic growth. The significant portion of the tax cuts and the tax reform plan that we just passed through Congress was a mix of two things. It was a mix of very fiscally sound policy that was going to grow the economy and a mix of good politics. And that's just the reality of having to pass legislation. This is an example of $70 billion of tax cuts in different programs. And while everyone agrees that a $1,000 child tax credit without phase-ins is a fantastic social policy, is something that we all want to encourage as families, it doesn't have the same economic growth as full expensing. That was one of the biggest challenges that the lawmakers faced when dealing with tax reform. It's the discussion of bang for your buck. The same $72 billion costs would have vastly different estimated revenue growth. Again, the big differences here are that what the policies that the federal government puts in place are going to either grow the economy or they're not. It's one of those things where we can do a lot of feel-good policies, but we also have to, as David always says, do the math. Take out a calculator and actually do the math. And here is David's do the math slide. The other thing that David is very cognizant of is the fact that projected growth and projected costs are not always right. So even economists might project that the Bush tax cuts absolutely did nothing and the costs were going to be ridiculously high. As you can see, this was the forecast of how much they were going to cost. Then what actually happened? The actual revenues grew. And it was a surprise to most economists at the time because they didn't think that a tax cut could have positive impact on the economy. The Tax Foundation, which is a nonpartisan, unbiased, but slightly biased towards tax reform organization, talks about increasing payroll revenues, and of course $293 billion is not small change. And that's it. Oh my goodness. All right, sorry to flip my way through very quickly, but the things that I know David really wanted me to portray is his genuine excitement at the economic growth that we're going to be modeling, at the way forward where labor participation rates are going to be increasing, where folks who previously weren't even interested in getting a job are now no longer applying for SSDI, are maybe going to go on unemployment rolls for a short period of time before hopping into the labor market because we have an over $6 million or a 6 million person shortage of jobs. So it's a really great time to be in the economy. It's a really great time to be a small business, and David is incredibly optimistic.
Let's see, this is working. All right, great. Great presentation. And you're much faster than David, so I appreciate that. No, David does a great job. David does a great job. But those were excellent slides. And you captured something that I really think is very, very important, and that's the optimism out there. When you combine the tax cuts with all the good work that's been done in regulatory reform, there is a real sense out there of businesses, small, medium, and large, that the animal spirits are really starting to go. What I'd love for you to provide is just a little bit. The last major tax reform was in 1986. Also, by the way, for those keeping score at home, the last year there was major immigration reform. We won't go there today. But my question is, how is the economy different today than it was about 30 years ago? And how do you stack this tax reform effort up with 1986? Some of the similarities, maybe some of the differences.
Okay, it works. It's actually a really great question. I don't often get what are the similarities? We had a very outdated tax code, and that would definitely be a similarity. In 86, there were hundreds of major companies in the United States whose tax burden was zero. Our tax code was defined by the Swiss cheese holes rather than the cheese itself. I think that we were getting pretty close with the tax code. Every member of the Senate, and I will also blame the House because I know David would too, would get their loophole or get their tax credit for a very specific thing. And then someone would come in and say, well, they got it, and I'm actually a very similar business model. Make an exception for this. And so it would create these little mouse tunnels in our tax code where money was pouring out and the rate had to stay up. And a 35% rate is not globally competitive. It's absolutely ridiculous. And so while we have amazing star power in the United States, businesses at the end of the day need to look at their books. And so a 21% tax rate at the corporate rate is going to be something that modernizes our economy, which was desperately needed. Differences today. David would absolutely be livid if I didn't mention technology, the gig economy, the fact that we are living in a world where everyone has their, mini computers at their hip. And the fact is that tax reform is going to have much more immediate effects because the information that all of us have is more than we could have had in a week in 1986, just at our fingertip.
Well, you mentioned some really important points. I mean, for the United States to have the highest rack rate, to have had the highest rack rate on our corporate income tax rate at 35% was just, to me, economic malpractice of the highest order. 35 out of 35 of the developed countries, so taking it to 21%, very important. Every state knows. No state would try to get you off by saying, hey, we're the best. We have the highest corporate tax rate. No state would do that, and governors get that, but for so long, Republican administrations, Democratic administrations didn't get that. One of your slides was very interesting because it had the effect of expensing. We can talk about the 35 to 21, but I'd love to hear some of your thoughts on the power of the expensing piece for businesses.
Absolutely. So the kind of behind-the-scenes sausage making, as David says, of tax reform, the full expensing was one of those biggest issues. We had folks coming in who were saying, you know what, I would love to go into a specific industry, but it's so capital intensive or it's so equipment intensive that I couldn't possibly go in because of the entryway. So I'm just going to work for another company that is doing the same thing. And while I know that I could run this company better, the barrier to entry is too high. We have seen, not just by the logic of it, but also by the CBO scoring, the JCT scoring, that expensing and full expensing is one of the #1 ways to get economic growth, by far. And what's interesting, and what David would share, is that it was very frustrating that we didn't actually get further with full expensing. But at the end of the day, when someone's there's a massive company that's going to be making, for example, plywood. They don't want a lot of competition, and they don't want 6 other plywood factories to open up. And so there were a lot of ingrained interests in not having full expensing. So that was a huge fight, and Congressman Schweikert is definitely on we're going to continue to fight and see what we can do for full expensing.
Well, we've heard, certainly anecdotally, from a number of companies, we're the state representative for the National Association of Manufacturers, and on the federal level, NAM and the U.S. Chamber played a huge role, along with the Business Roundtable, in rallying business support. But that expensing provision and the pass-through reduction and the reduction of the corporate income tax rate, we're picking up, that it's really encouraging companies to purchase that extra piece of equipment. And I'd love for some of your thoughts on, that this is a bill that is designed to benefit businesses of all sizes. And I know that there was a major battle to change some of the provisions so that the benefit would also flow to companies that are not organized under the corporate income tax portion of the U.S. tax code. Maybe if you talk a little bit about the thinking behind that and what you expect the effects will be with the final product.
Yeah, absolutely. So the pass-through issue is so complicated and so challenging that even President Obama, who had been talking about corporate tax reform, was unable to do it. And that was, this wildly popular president that the Democrats would pretty much do anything for, was not able to do tax reform because of how complicated the pass-through issue is. So it's a small miracle that everyone got on board, but at the end of the day, the small businesses right now are going to have significantly reduced tax rates. And at the end of the day, whether you're organized as a pass-through or otherwise, the lower rates are going to be the biggest thing. And while there are probably going to be, I would estimate Treasury would have some regulations that they're going to be issuing regarding the pass-through rate to provide some clarification, because that's just what Treasury does. I think that the pass-through provisions are well written enough where all of the people who are really concerned that, the pass-through rate is just the highest rate for individuals. It's not true. That concern will hopefully be put to rest this filing season as Treasury issues some regulations and kind of just clarifies. But at the end of the day, the lowered pass-through rates and the ability to have a business that's established as a pass-through is going to be remarkable to our economy. The economy is being run off of small businesses, not of giants at the end of the day.
We have a number of state lawmakers here, and there is a discussion going on in terms of conformity that's taking place in Arizona and across the country. Would be interested in your thoughts on how the federal tax bill, now that its law is going to affect what we need to do here in the states. And any thoughts that you have in terms of how Arizona can best take advantage of the law would be helpful as well.
So Congressman Schweikert genuinely believes that Arizona is going to be one of the significantly better off states under this tax code. And that's pretty easy to see. Lower state and local taxes, great demographics with lots of younger folks. Overall, it's just a great environment, as you all know, to invest and to be here in Arizona. At the end of the day, David would joke, and then he would preface it and say, well, I'm only joking, but I'm kind of joking, but I'm serious. Arizona's in a great place because California, their taxes are so high that if they can't deduct from the federal level every single thing that they do at the state level, that state folks aren't held accountable for in California, is going to inevitably be a little bit better for Arizona. And we're going to have folks realize that this is a great place to be, that this is really affordable, and that at the end of the day, the money that is put into the state and local taxes here are doing a whole heck of a lot more than perhaps they are in other states.
So the change in the SALT deduction, and your point's really important there. As companies are looking to invest and maybe they want to do that extra line, that this is sort of that point in time where they really may be thinking, if they were inclined to move, this would, I would expect, perhaps accelerate it. I was at a great friend from GPEC, Allison Gilbreth, is in the office, is in the audience today. I was at a fascinating GPEC dinner with a number of people. I won't name any names, but from Chicago, California, New York, and it was very, very clear, this was about a week or two ago, that the tax law is changing how they're looking at things, and it's very advantageous for Arizona because a number of higher tax individuals or perhaps businesses that are organized under the pass-through are going to be looking for friendlier climates. So I think that this bill for states like Arizona is a clear winner. Question for you. You've been on the Hill for a while. I used to be a Hill staffer many moons ago. when I think the Whigs were in control. Has it surprised you how fast sort of the sugar has hit the bloodstream on this bill in terms of all the good news that's come out?
Oh, absolutely. And I mean, we've tried to keep track as best as we can internally. We have a little list, and we have folks working on making sure to keep track. But it is really, really surprising. Apart from I'm not in comms, thank goodness. So, apart from the comparison side tweets of some of our Democratic leadership saying that $40 is tax cuts are the bee's knees, and then saying $1,000 of tax cuts is not going to do anything. Apart from those types of easy wins, there are companies that really genuinely are going to reinvest the money that they are receiving. And apart from, the taglines of corporate responsibility and all of that, it is remarkable. I probably shouldn't call out, but I mean, what was it, CVS yesterday or 2 days ago announced that they're going to increase pay and do like a paid family leave program? For everyone who's on the left who really thinks that all of these programs belong at the federal level, this is remarkable to see all of these companies wanting to give back to their employees. And it has been incredibly surprising and really wonderful, but incredibly surprising.
Well, it's really amazing that it's hit. We've seen bonuses, we've seen lower, we've seen utilities in the state change plans and say that they're going to return a lot of money to ratepayers. We've seen a lot in capital equipment. You mentioned employee benefits. We have a great Arizona-based bank, Alliance Bank, where they're raising the minimum wage or the wages for the workers on the lower end of the scale, as well as increasing benefits such as the ones that you've suggested. Charitable contributions have been announced by many companies that they're going up. So this is something that is usually in the business of politics and policy. The surprises, the unintended consequences are not pleasant. This has been really, in my opinion, a nice exception to the rule. And I just want to say I really appreciate your terrific staff work. Congressman Schweikert has been, we're very fortunate in the state of Arizona to have him on the powerful Ways and Means Committee. I know a lot of the people in this audience spoke with Kat or the congressman during the consideration of the tax reform bill, and I think we can all say that the final product really turned out well. I want to thank Kevin Knight from the congressman's office, who's in here as well. The congressman has a great team, and Kat, I just really appreciate you being with us today, and you really did a terrific job of explaining the benefits of this landmark new law. Kat, thank you for being with us today. Thank you for helping me figure out how to use the microphone, too. Let's see here. I think now we're at the second half of the program. They don't give me a halftime. I'll take this seat. We'll play musical chairs. Go crazy here. Let's see here. What we wanted to do at this breakfast is to first have an overview from an expert on who was inside the sausage-making machine, so to speak, and Kat, you did a fantastic job at that part. I want to also use this as an opportunity to dig in a little bit deeper in terms of some of the technical aspects that would be of interest to all of us here in the office, in the audience. And today we're joined by Cathy Green, principal at CliftonLarsonAllen, who has more than 25 years of experience in tax, specializing in trusts and estates, high net worth clients, and tax-exempt entities. We're also joined by Dave Damon, a partner at Ernst & Young. Dave has more than 22 years of professional experience, who serves as a tax account leader on a number of clients in both the public and privately held arena. Dave has focused heavily on closely held businesses, startups, and strategic growth accounts, seeing a number of them from infancy to IPO. And please welcome Cathy and Dave. sister who's a certified CPA, I just thank you for what you do, and I really thank my sister around April of every year for her help. Before we get to some of the technical questions, we'd just love just sort of a sneak peek. What are you hearing from your clients now that this tax law, in terms of questions or just, I would just be interested, just sort of, this is now law. What's sort of the buzz?
Well, we've actually been getting questions starting back in December, people wanting to know what was happening, and it was very challenging for us because we were trying to keep up with all the different variations of rules, and we'd think we had it handled, and then there'd be a curveball thrown in there, and so we're now to the point where we know what's there. Still a lot of areas that we don't know about, and so I was just telling David that my firm actually put out an email saying it's okay to say I don't know, which we have a hard time doing as CPAs. We want to be able to say this is it, this is how you do it, this is what we recommend, but we're in that situation of I don't know a lot of times. But the things we do know and the things that we're getting questions on are about the 20% reduction for pass-through income for individuals. Getting a lot of questions about limitations on the mortgage interest and the overall limitation to $10,000 for the state and local taxes as well as the real estate taxes. My firm just had a tax reform presentation yesterday, and a lot of the questions were, should we think about converting to a C Corp from an S Corp? And it's like, maybe. That's our favorite answer. It depends. And so, a lot of those kinds of things are really on people's minds, and we're, working very hard to try and do models and projections and stuff. But again, there's still more information to come. So even what we think is the way it should be interpreted, there may be some variations that are coming forward.
And I'll just add, it has been rapid fire. Mm-hmm. Law passed, right at the end of December. I serve a number of public companies, so companies have to reflect the effects of this reform package in their financial statements that are being issued right now. So a lot of the I don't know is what we quickly have to figure out what we're going to reflect in our financial statement. So it's been very exciting, very interesting time. A number of the provisions, as Kat mentioned, we are waiting anxiously for additional guidance to come out so that we can make sure that we're interpreting them as it was intended to be. But yeah, it's definitely rapid fire.
I would just say, in terms of those interpretations, our day job is advocacy. So where there's things where we should be aware of, where we could help and communicate this with our delegation, the administration, we certainly want to do that, because something of this scope, there's always going to be regulatory issues, and there's always going to be opportunities to perfect and clarify certain provisions. If we could dig a little bit deeper, and we'll get to some of the issues around corporate income tax and repatriation in a moment, but I'd like to, there was already a little bit of discussion of the 20% of qualified income. And if maybe we could discuss this deduction available for itemized or standard deductions. Just what restrictions exist? How should we be thinking about this overall?
So this whole 20% deduction has caused a lot of questions, and it's really complicated. So whenever you hear about tax simplification, it really wasn't, and we've got all these additional complications. But the reason why this 20% deduction even came to be in part of the tax reform bill was because they're trying to level the playing field a little bit between the flow-through income that people are having to pick up in their returns and then the corporate rates, because the corporate rates are now going to be 21%, which is a low rate compared to what they have been in the past. And individual rates had been 39.6. Now it's 37 is the highest rate. And so the idea is by putting this 20% reduction in place, you're bringing that effective rate, if you're able to take all of the deduction, bringing that effective rate down to closer to, I think it's maybe 29%. So even still, there's a swing between the flow-through income being taxed and the corporate income being taxed, which is one reason why people are wondering, maybe I should be converting to a C Corp. But regardless, the way this is set up to work is the question was, is it available to itemize deduction people or standard? It doesn't matter if you itemize or you're standard. This is outside of that. And the other thing that we know, we don't know exactly how it's going to show up on the return, because this is for 2018 returns that aren't available yet, right? But the idea is we always have a saying if something is above the line or below the line, and that means, is it deductible before you get to adjusted gross income, or is it deductible after? The one thing that's clear about this deduction is it's after, below the line, so it's not affecting adjusted gross income, and that's important because adjusted gross income is used for a number of different limitations for deductions, and it's also important for state purposes, not for Arizona, but other states that use adjusted gross income as their starting point. So the question then is, how do you compute this thing? And there's different levels, okay? So the first thing you have to look at is qualified business income, because that's what the 20% deduction is for. And service type businesses are not considered qualified business income, except for architecture and engineering. So they must have had good lobbyists there. I don't know why those two were carved out, but regardless. So if you have that type of service business, so we as accountants, we would not be able to even be eligible for this, except if you have married filing joint couple that has taxable income of $315,000 or less, then that restriction for qualified business income doesn't even come into place. So you can see it's already starting to get a little confusing, right?
So if your income is under $315,000 and you're in the service side, you can use that 20%?
That's what it looks like, yes. Now, then a further limitation is you have to look at the amount of W-2 wages that are paid as part of this business. And there's another limit that you look at if there's, 50% of wages, or you use, I think, 25% of the W-2 wages, plus 2.5% of your property. And again, that's a good thing for real estate people. So we think probably real estate had good lobbyers in there saying we need to be able to have something in there for the property. So again, you've got this other limitation. And then, you look at that, and then there's an additional limitation as far as the taxable income that you can offset by this deduction. You have to look at taxable income taking out long-term capital gains and qualified dividends that are taxed at a preferential rate. So you can, we went through it quickly, but you can see it's not an easy question. And then you have the question of, what if I have multiple businesses? How does that calculation work? And that's something that there's more guidance coming on. So simplification it is not, but that is the theory of kind of the items that you're looking for in that 20% deduction.
She got it.
Thank you.
I did as best as I could, so.
Thank you. Very fortunate. I noticed Don Grove, who's the chair of our Arizona Manufacturing Council, is here today, and as I mentioned, NAM and its head, Jay Timmons, and his team played a major role in the passage of the tax reform bill. I'd like to dig in a little bit. The Act allows, as we discussed earlier, for full expensing of short-lived capital investments such as machinery and equipment over the next 5 years. What are the short and long-term impacts of this provision for Arizona manufacturers and businesses?
Can I talk this time?
We're going to mix it up.
So I think this is a significant win for not just Arizona manufacturers, but for manufacturers throughout the U.S. So maybe just a quick history lesson. So under the old law, right, we were able to expense 50% immediately of any qualified assets. The new law changes that to 100%. And also does one additional thing, which is changes the definition of what qualifies in terms of being new assets. In the past, it had to be a brand new asset. Now, it actually can be, it just has to be new to you. So you could now have a situation where used assets that a company may go out and acquire will actually qualify. That's very significant for companies that do look to acquire machinery and equipment that may very well be, a year or two old that somebody else is trying to get rid of. So, very significant change in not only the amount, 100%, but also the type of asset that qualified doesn't have to be brand new. This phases out, so it's 100% expensing through 2023, and then we start to phase out, and it's gone by 2026, or at the end of 2026. I think one of the things that you'll see is obviously because of the ability to expense everything right away, you'll see a lot of investment in new equipment. You'll see factories start to significantly increase efficiencies because of the new equipment that they go out and acquire. The one thing that also I think will be very interesting to see is how this changes the M&A landscape. If you think about M&A activity, right? Currently, if you go out, or under the old law, if you go out and do a taxable acquisition of assets, buy a company's assets, a whole business, that did not qualify because those were used assets to you. Under the new law, if you decide to go out and acquire a company via an asset acquisition, all of those assets that you acquire are now eligible for 100% expensing in the year that you acquired them. So significant from an M&A perspective, and I think you'll see some of the M&A activity start to trend towards asset acquisitions, at least while this is in play.
So the one part that's interesting about all of this is most of the tax reform affects 2018. This particular provision is back to September 27th. Is that right, 27th? So for 2017, we have the added, complexity of having a couple different depreciation rules in the same year. So that's something that we're looking for on returns and stuff. But it was interesting to me that they made that one kind of effective in 17, whereas everything else is pretty much in 18.
So in addition to great information, I can see a lot of wheels turning here in the audience. Going back to the corporate income tax, we discussed earlier going from 35 to 21, we thought was extremely important. But another portion of this was what happened in terms of repatriation and moving towards a more territorial-based system. Would love your thoughts on how on the effects of that move.
So I'll start, and you can certainly chime in, Kathy. So this is significant. I think you'll see, because all of this cash is now available here in the U.S., or potentially available here in the U.S., a lot of the things that we saw in the clip and that Kat was talking about that we've already seen starting to move, I think you'll just see continue to roll on down the line, right? You have increased investment in the United States. You'll have increased wages. I think it's very significant. A bit of history. So under the old rules, right, the U.S. system was taxed on a worldwide basis. So it didn't matter if you earned $1 of income in the U.S. or $1 of income in France, you paid tax on it in the U.S. Maybe not right away. If it was earned in France, you had some deferral opportunities, which is what gave rise to this transition tax, and why so many companies had such large amounts of cash sitting offshore. But nevertheless, you did eventually pay tax in the U.S. Transition to the territorial system that we're now in, or quasi-territorial system that we're now in, and you had to have some transition to be able to go from this worldwide system to a territorial system. And so what the new reform package included was the ability to have access to that offshore cash in the U.S. at favorable rates. So they gave us some incentives to bring that cash back. You didn't really have a choice. It was mandatory essentially. But now companies in the U.S. have access to their cash that has been sitting offshore. Mandatory, not elective. So you do have to pick it up, and this is another one that's in the 2017 return. I won't get into all the crazy rules about how you figure out what exactly needs to get included, but nevertheless needs to be included in the 2017 return. And different ways that companies can pay for this tax. They can, if they have existing attributes carrying forward, so things like net operating losses, foreign tax credits, things like that, they can use those. If they want to pay cash for those, for the tax, rather than use their attributes, they can do that. Cash you can also spread over 8 years. So there's some options, and the companies will have to really consider what it is that they see long-term, how valuable are their attributes that they do have carrying forward. What does their projection of future taxable income look like under the new system? What's the time value of money? Lots of things that they'll need to take into consideration, but long story short, it avails companies to a lot of access to cash that has not previously been used in the U.S.
The one thing I'll just mention about this is, you've probably noticed this too, is every day this week with the tax releases that we get from our different research services and stuff, it keeps saying the IRS says we need to get guidance out on how to make these payments. And it's another example of where the parameters were put in place, but the specifics were not given. And so that's one area that we're expecting guidance to come out relatively soon, because people are getting anxious about how do we handle this for our 2017 filings.
Not a bad time to be an accountant. What is the base erosion anti-abuse tax, or BEAT, and whom does this apply to?
Okay, so this is a new provision that basically is designed to curtail the tax benefits in the U.S. of any payments that companies, large multinational companies, pay to foreign-related parties. So it's only large companies that this even applies to. So large is defined as 500 million average annual gross receipts over the last 3 years. And it's also another very complex calculation. But essentially, most payments that a U.S. company makes to a foreign affiliated party will fall under this law, with the exception of anything that ends up in the cost of goods sold line. So if it's not cost of goods sold related, so things like royalties, interest, if you acquire fixed assets from a related party overseas, those will all be subject to this new tax. And again, very complex, but I think the thing to keep in mind is if you're large and you do have a lot of payments from the U.S. to foreign parties, this is something that you need to keep your eye on. This is another one that we're expecting significant guidance to be coming out on, because of the language was very short in the new law, so more to come. The one thing that I will add, if I could just real quick, there has been, if you follow the news at all on the BEAT tax, there's been some focus on whether this is discriminatory as it relates to tax treaties that the U.S. has with other countries. So most of the tax treaties, if you look at the U.S. model tax treaty, it has a non-discriminatory statute in it. And what that says is basically country A's company and the U.S. companies are treated no differently whether they're doing business in country A or in the U.S. Under the BEAT, right, if you just think about what I said, where payments are made by a U.S. company to a foreign-related party, that may be subject to a haircut, essentially, under this new law. Whereas that same exact payment, if it was made to a U.S. company, would not be subject to a haircut. So it seems like there's some discrimination there. The conference reports in the new law did not include anything associated with reference to the tax treaties that exist currently. So there's a question as to whether does this new law trump tax treaties? What's going to happen? So more to come on that, but long story short, that could have some ramifications.
you covered it great. So.
Real quick, and then I'm going to close with an Arizona-specific question. What does the repeal of the corporate alternative minimum tax do? There was a lot of debate on that provision and a lot of concern that if that wasn't addressed, it could really erode the benefits of things like the federal R&D credit and some other things.
So for us, there were small corporations that were not subject to alternative minimum tax if they had less than, I think it was $7.5 million of receipts. And so, those companies weren't affected anyway. These are more the large corporations that are no longer having the AMT. And there's some changes as far as depreciation. We used to have separate depreciation records for federal, for AMT, and then for state. So now, for those large corporations, we don't have to worry about the AMT portion. And there were also some different credits and elections that previously were taken, that you had the option to take a reduced amount so that you didn't have an AMT adjustment. So now, that won't be an issue. There's also minimum tax credit carryovers that are available that generated whenever these corporations paid alternative minimum tax on not timing items, but more like permanent items. And so those minimum tax credit carryovers are still available for companies to use to offset regular tax liability going forward. And there's even possibility to be able to use extra amounts of these credit carry forwards in certain years.
I'll just sum up what Cathy said, which is it makes things much simpler, right? You no longer have two systems that you have to focus on if you're a company. I wish they would have done this for individuals too, but understand why we couldn't get there. So there's only one system. So from a tax planning standpoint, from projecting future taxable income, all those things that make it complex, this is one of the things that we got simplification on.
Great points. Close, interested, had a little bit of discussion on what's going to happen on the state level. We've got a number of state lawmakers here. There's going to be a robust discussion, I'm sure, on tax conformity. Now that the federal law is passed, what effect does that have on Arizona? Any thoughts on how we should think about conforming or not on the state level? How should we approach this?
Well, for states, they have several options, just as general background. You either have rolling conformity, which means that they automatically adopt whatever is done for federal, and that makes it easy then for the residents to know exactly what their tax rules are going to be. Arizona is not one of those states. It's a static conformity state, which means it refers to the laws in effect of a certain date, and our date is January 1st, 2017 for now. And I don't know what they're going to end up doing as far as deciding if they're going to pick and choose items they're going to conform with. What are your thoughts?
So my personal thought is, I would expect that we would probably adopt the new Internal Revenue Code with some carve-outs. So probably the biggest one being the new bonus depreciation rules. I could see that being an easy one, since we have not in the past adopted bonus depreciation. We probably will steer clear of the 100% bonus depreciation, but to be determined. I think the other thing that'll be interesting, Cathy and I were talking about this a little bit ago. Arizona Department of Revenue actually did a study based on the new Internal Revenue Code and showed significant increase in our tax revenue, income tax revenues associated if we did go the route of conforming, because of the fact that a lot of the provisions that we've been talking about are base broadening provisions. So if you increase taxable income and you don't do anything with the rates, right, logic has it that Arizona tax revenues would increase because people were going to be paying more. So I could see two things potentially happening. One, we lower our state rates, maybe, hint, hint. Or two, and maybe it's some combination, there's probably some other things out there as well, but number two, do we invest some of that increased revenue in education? So those are my thoughts.
Well, this has been a great discussion, and I appreciate us closing on that area, because right now, the Arizona Chamber, we're in the middle of writing our fiscal task force report, which will provide our recommendations to the legislature and to the governor on what we would like to see happen. And we have for a long period of time, we've been supportive of bonus depreciation, further reductions in capital gains, as well as looking at rate reductions. I just want to thank our panelists, Damon and Cathy Green, for just a great discussion. Let's give them a nice warm round of applause. And I really want to thank Dimenstein for stepping up and just doing a great job outlining all of the different key elements of the landmark tax reform bill. Thank you to our sponsors, and we look forward to seeing you at another Chamber event soon. Safe travels. Thank you.